Imagine the scene on August 5th when Whale Alert flashed a colossal movement of 20 million XRP for roughly $58.6 million, leaving the Upbit exchange and landing in an anonymous whale wallet. A maneuver that on its own could tilt market perceptions and ignite bullish speculation. At the same time, CoinGlass data paints a picture of long-term holders withdrawing a net 29.38 million XRP from spot exchanges in the past 24 hours. A dynamic historically associated with accumulation and a growing conviction that prices will rise. Taken together, these on-chain signals suggest that major investors are quietly positioning to absorb sell pressure and hold for future gains. Yet the market's reaction is anything but one-sided. On one hand, the narrative of whale accumulation and exchange outflows creates a foundation for optimism. When whales pull tokens off exchanges, it signifies less available supply for selling and more locked-up capital awaiting a higher price. Such behavior often precedes significant uptrends, as these large holders can absorb retail sell orders and resist liquidating their own positions, creating a bid wall that underpins price. Moreover, exchange outflows reflect confidence in the asset's trajectory, since holders prefer to secure their tokens in private wallets rather than risk them being tagged for immediate selling. If these combined actions become widely known among market participants through on-chain analytics shared on social channels, they can trigger a self-fulfilling cycle. Retail traders see the accumulation, buy in anticipation of a rally, which in turn validates the whale's strategy and drives the price higher. Yet on the opposite side of the ledger, skeptics caution that such movements, while significant, are not guarantees of an imminent rally. $3.30. The current market price sits near $2.93, having retraced more than 4% in the last 24 hours, and trading volume remains flat, an indicator of market indecision rather than conviction. Data from the XRP liquidation map reveals that the majority of short positions, totaling about $75.65 million, are clustered around $3.113, creating what traders call a short wall. Should prices approach that level, these shorts could act as a barrier, with bears defending their positions by selling into strength, thereby capping any rally. Conversely, there are roughly $42.85 million in long orders resting near $2.97, forming a long wall that can trigger stop-loss cascades if the price dips below it, potentially dragging XRP down toward $2.85 or lower. This tug-of-war at critical levels infuses volatility into every move. A push above $3 might ignite a short-covering squeeze, fueling a surge toward $3.30, yet a stumble through $2.97 could unleash a flood of stop-loss orders, generating a sharp drop that undermines bullish confidence. In low liquidity conditions, such liquidations can be dramatic, catching traders off guard and reinforcing bearish sentiment, especially if macro factors shift against risk assets. Against this backdrop, technical analysis offers both encouragement and caveats. On the 4-hour chart, XRP appears to have transitioned back into an uptrend after breaking above a key resistance level, one that marked the peak of its recent rally, only to retrace and retest that breakout zone. This retest is a classic confirmation pattern. If XRP holds above the old resistance at around $2.85–$2.88 and resumes upward momentum, it signals strength and often precedes a 10% to 15% advance. The activation of a green Supertrend indicator reinforces this bullish bias, as it suggests that the price, having crossed above the Supertrend line, is now trading within a confirmed uptrend. Yet such signals can be false when market breadth is weak. A Supertrend flip without sustained buying volume might represent nothing more than a brief reprieve in a broader downtrend. Confirmation ideally comes in the form of expanding volume, particularly from spot exchanges in Asia and Europe, coupled with continued outflows of XRP to private wallets. Without that depth of participation, any rally may stall at the $3 pivot, leaving traders to wrestle with the very short and long walls that threaten to contain price action. Macro factors add another layered dimension to the debate. The broader cryptocurrency market has shown resilience in the face of mixed economic data from the United States and Europe. Inflation appears to be cooling slightly, prompting central banks to adopt a cautious tone on future rate hikes, and risk appetite has returned to some degree. In this environment, altcoins and crypto tokens like XRP often enjoy a disproportionate boost. As capital rotates out of traditional markets and into digital assets searching for yield and growth, if global liquidity remains ample, driven by accommodative monetary policy or renewed institutional interest in crypto as an asset class, XRP stands to benefit alongside its peers. On the flip side, if central banks shift back to tightening, or if unexpected geopolitical tensions flare, risk assets could face renewed selling, and XRP's outperformance would likely be overshadowed by a flight to safety in fiat or more established cryptocurrencies like Bitcoin. Furthermore, regulatory developments loom large. Any announcement from the US SEC regarding XRP's legal status could sway markets dramatically, either removing an overhang and spurring a rally, or adding uncertainty and triggering a sell-off. The interplay between these macro and regulatory forces underscores that while whale accumulation is a potent signal, it does not operate in isolation, beyond price charts and macroeconomic headlines. Sentiment analysis provides valuable context. Social media platforms have lit up with discussions around the whale alert transaction, some influencers framing it as a bullish omen that could see XRP surge above $3.30 in the coming days. Such narratives can gain traction quickly, drawing retail traders into the market and amplifying buying pressure. Conversely, bearish commentators have seized upon the flat trading volume and the concentration of shorts at $3.113 to argue that whales may be orchestrating a buy the rumor sell, the news play accumulating quietly, only to distribute at higher prices once retail momentum peaks. In that scenario, a rally could be met with stealth selling by the same whales, turning the near-term bullish setup into a trap for overzealous bulls. The resulting reversal would reinforce negative sentiment and potentially lead to a cascade of redemptions from leveraged positions. Given this dynamic, seasoned traders often look for divergence between on-chain whale actions and market sentiment. A disconnect such as increasing whale accumulation paired with rising doubt among retail investors can sometimes presage a strong countertrend move once the sentiment pendulum swings back. Liquidity metrics on exchanges also merit close attention. The depth of the order book at key thresholds, particularly around $2.85, $3.00, and $3.30 reals, the true support and resistance landscape that will dictate price behavior. If buy-side liquidity at $2.85 remains robust, it can serve as a firm floor, enabling incremental buyers to push the price back toward the rally's inception point. However, if that depth evaporates, as can happen during periods of high market stress, then even moderate sell orders can cause outsized price swings. The converse is true on the ask side. If significant sell walls materialize near $3.30, they can blunt upward moves, forcing bulls to grind through multiple layers of resistance. In some cases, those walls are placed intentionally by large stakeholders to manage their liquidation pathways. Adding another layer of strategic complexity, monitoring real-time changes in the order book, especially pairing that with alerts from on-chain monitoring tools, can provide traders with a window into institutional behavior, potentially signaling when the path to $3.30 is unobstructed or when it's being actively defended. Risk management strategies in such an environment are paramount. Traders wagering on a push to $3.30 might consider scaling their positions, initiating a base layer of exposure near $2.90, $2.93. Adding to that as XRP holds above $2.85, levels just below the $2.85 support to guard against a breach. Profit-taking could be structured in tranches, perhaps reducing position size near $3.05. Further trimming at $3.15 and closing out most of the remainder around $3.30 to lock in gains while leaving room for a breakout continuation. For those wary of sudden reversals, Option strategies such as purchasing calls with strike prices at $3 or $3.50 can offer leveraged upside with defined risk, although the premium cost and time decay must be factored into the equation. Longer-term investors, meanwhile, might view the whale accumulation and exchange outflows as confirmation of a strengthening base. Choosing to hold through short-term volatility with the conviction that XRP's broader adoption driven by payment, network partnerships, and DeFi integrations will drive demand over time, yet even these stakeholders should be prepared for potential drawdowns. Given the market's propensity for sharp corrections when sentiment flips,